Today we're talking about how to fund a new or an existing business with existing retirement funds. In other words, how to fund a business with a 401k. This is a proven strategy designed to let a person use existing 401k or IRA accounts to fund a business. It allows a person to access those retirement funds without penalty or taxes, regardless of their age. And it works off an exemption to the prohibited transactions, which is IRC 4975 subsection D 13. The following are steps to implementing this strategy. Step 1, form a C corporation. What is a C corporation? A C corporation is simply a standard business corporation. It is taxed under subsection C of the IRS code. Why form a C corporation? C corporations offer business owners limited liability, which removes a lot of the personal liability from the owner. They are a more formal business structure. They give the ability to reduce overall income taxes. They allow companies to accumulate assets in the business. And most important, with a C corporation, you can do a private stock offering, which is called a qualified employer's securities transaction. The steps to forming a C corporation include a name reservation. A name must be reserved prior to filing articles of incorporation with the Secretary of State. Prepare articles of incorporation. Follow your state's guidelines for the preparation of these articles. File the articles of incorporation, and again, follow your state's guidelines for preparation and filing of those articles. File the initial registration. And this must include 3 principal officers. Publication of notice of intent to incorporate. You must publish a notice of intent to incorporate in the newspaper, which is the official legal organ of the county where the initial registered office of the corporation is to be located. And most important, seek professional legal and tax advice. Step 2, the C corporation establishes a 401k. Any business, whether a C corporation, S corporation, partnership, or sole proprietorship, can establish a 401k retirement plan. The company sets the eligibility requirements within certain guidelines at the time the plan is established. Each individual employee can defer in 2008 up to $15,500 or 100% of their annual compensation, whichever is less. So the new C corporation establishes a new 401k retirement plan. Participants age 50 and over can make an additional catch-up contribution of $5,000. 401k plans may permit self-directed investment accounts and company stock purchase within the plan. You can choose Roth status, meaning contributions are after-tax dollars. This means the growth and subsequent withdrawals are not taxed. The employee may participate in profit sharing. With profit sharing, you may shelter up to $46,000 per year. Step 3, rollover. The owner of the C corporation will roll over funds from an existing 401k or IRA to the new 401k. You must, however, be able to roll over these existing accounts, and you can check with your plan administrator to find out if you can roll those funds over. The existing plan then sends a check to the new plan. The trustee for the plan, which is the C corporation owner, receives the check and deposits the check into the plan's checking account. Now keep in mind who the C corporation owner is. It's you. You set up the C corporation, you're the owner. So again, we've established a new C corporation. The C corporation started a new 401k retirement plan. We now have an existing retirement account and we roll over the funds into the new 401k retirement plan. Step 4. The C Corp offers a QES, which again was a qualified employer's securities transaction, which is nothing more than a private stock offering. C corporations are the only corporations allowed to do this. Keep in mind, I told you earlier that you had to form a C corporation. This is why. The newly formed 401k then invests its funds in the C corporation. The newly formed 401k then sends a check to the C corporation, and now the C corporation is funded. Now let's look at a diagram. Again, we had the new C corporation formed. That C corporation established a new 401k retirement account. The owner of the C corporation then rolled over existing retirement account funds to the new 401k plan. And then the 401k plan turns around and invests in the C corporation in exchange for stock. This is how you've taken existing retirement funds, moved them to a new account, and invested that in your new company. Of course, we have rules we have to follow. You must work at least 1,000 hours per year for the company. This is based on salary. You must have a reasonable compensation. In other words, you have to have a reasonable salary based on the position that you have. You must be at least a minimum wage earner for the state that you are in. You must keep this an active retirement plan, which means you have to invest at least 1% of your salary into a new separate retirement account, which again can be a self-directed IRA. The 401k can own no more than 95% of the corporation. Remember, the 401k invested its funds into the corporation through buying stock, which makes the 401k an owner of the company. The 401k can own no more than 95% of the shares of stock. You have to retain at least 5%. Now here's the kicker. Back to that active retirement plan, where you must put at least 1% of the salary into a new separate retirement account. A self-directed IRA is allowed to invest in businesses. And as long as you personally are not 50% or more owner of a business, you can invest those retirement funds into that business. And what this is going to do is it's going to allow you to shelter more and more money from the IRS. And back to the 401k owning no more than 95% of the corporation, this has to be true all the time. There can never be a time where the IRA or the 401k owns more than 95%.